Hello and welcome to Moneyline. This is Matt McCall. Thanks for joining me on our Friday edition here, wrapping up the week. We got a big show ahead of you. We're talking about the market update. We're going to talk about the pullback we've had in some of these technology stocks. The biggest week in IPOs in over a year. We're going to talk about names. We're naming them, which ones to keep an eye on. We're also going to talk about a sector that's breaking out. As interest rates and mortgage rates hit lows, this sector is doing well. That and your questions, as always, coming up now on Moneyline.
The buck starts here. Moneyline with Matt McCall.
All right, again, I am Matt McCall. Thanks for joining me today. It is Friday, September 18th. I'm rocking my little company man here, Investor Play shirt, as you can see. It may be a little too tight on me, but that's fine. But we got a nice show in front of you here today. We have the market up. It's kind of mixed right now. I'm doing this at about 5 of 11 East Coast time. The Dow's down 68 points now. I think the S&P last time I checked was down about 18 or so down about 0.5%. We were a little bit higher this morning, but you're not seeing a lot of reasons to buy right now. I mean, I love long-term buying here, but it's just this slow dribble of people, just negativity in the market, and that's fine. This is just creating opportunities for us. So for me, this is nothing more than looking at individual stocks right now and using that as an opportunity to buy. We had our early stage investor, which is our small cap newsletter, went out this week on Wednesday after the close. We added a new stock there. It was actually a SPAC, believe it or not, one of the SPACs. I don't know if I've mentioned it yet or not, but we put that as a buy recommendation. And I'm happy to say that's holding up really well, even though the market's pulling back. We have that. And then actually yesterday I bought a new stock, that's another smaller cap stock for my clients, some of my clients at Penn Financial Group. Happy to say that one seems to be doing well this morning as well. Actually, it's up nicely today. So, yeah, there is buying opportunities. I'm not saying you rush into the market if you're seeing 100% cash now, but you have to pick and choose. You look for companies that are strong, that have pulled back. What I'm going to mention, I'll mention right now only because I can't remember what firm came out, but I saw this morning as I was reading, they came out and said this company, RINGCENTRAL, which we use at Investor Place all the time to do our calls, our video calls and everything with remote. And symbols RNG, we have it in our power portfolio that Louis Navalier and I put out. We did our first one last year, and we do it just for the year. And we put out usually 8 to 11 stocks-ish around there, and those are stocks you hold for the year. And our goal is to triple the benchmark, which is the Dow for us for that. And we're up like, I think 20-some% of the Dow up like 1% or something. I just did the numbers from the other day. Either way, we're crushing it. This is one of the stocks hit an all-time high. It's had a hell of a year because, as you know, RINGCENTRAL and the work-from-home stocks have done well. So since we put this out, the official date was December 10th on this one. Since that time, the stock's still up 53.5%. 53.5%. However, it is down well off the highs. If you take it from the intraday high down to the intraday low of yesterday, stock was down about 25%. So one of the firms came out and said, listen, this is just an opportunity to buy a stock that's 25% from an all-time high. It got a little ahead of itself, but then the selling gets ahead of itself. There's so many stocks out there that are similar to RINGCENTRAL that I see for subscribers, for clients, for my own money, that are just great opportunities right now. And I don't know if I'm buying a stock down 15% or 20 or 25 from the recent high, if that is the bottom. I do know that I like the company, I like the stock, and if it's 20% cheaper than it was a month ago, that's great because I'm looking at a couple years anyway. That really helps my potential reward to risk. Think about this. If we'll just use a $10 stock, for example. So a $10 stock, say you like a stock at $10, and you think the potential in the next 5 years, 3 to 5 years, let's say, is a 5-bagger. They can go from 10 to 50. And you all know I'm crazy when I say that, but it's realistic because we have Workhorse in the portfolio, which is now up about 960% in 4.5 months. So it's very possible, folks. 960%, almost 1,000%. We're getting close to it today, and I keep watching because as soon as it gets it, I'm sending an email to the entire company. And I'll be bragging a little bit. So, because it doesn't happen that very often, especially in 4.5 months. That's insane. Stock's at $10. You think it goes to 50. So you got $40 on the upside. and you say your downside is 50%, let's say, it can go to $5. You don't think the downside's any more than that. So you have 40 to the upside, and you have 5 to the downside. Do simple math, that's an 8 to 1. Your reward is 8, your risk is 1. Again, we're at 10, going to 50, that's 40. 10 going to 5 is where we think the downside risk is 5. So 40 over 5 equals 8. So 8 to 1 reward to risk. If that stock then pulls back to 8, our reward increases to 42, because 42 to 50 is now 42. I might have to do this math on this paper here. Increases to 42. And then on the downside, our risk is now 3. So 42 divided by 3 is what? 14? I'm just doing that in my head. 14, right? So now it's 14 to 1. We had an 8 to 1 reward to risk. Now it's 14 to 1. It makes that so much more attractive in the long term. So when you buy on pullbacks, not only are you buying closer to what you think that the downside risk is, so your downside risk is less, but your upside reward potential increases. So it's a substantial difference from an 8 to 1 to a 12 to 1 reward to risk. Both are fantastic. So that is why I love buying on these dips. But again, I don't know. Maybe it tests 6 before it goes to 50. I might be wrong and it goes to 5. I don't know. But the point is, the closer you buy, these pullbacks make the entry that much more attractive over time. It makes percentage gains that much more attractive over time. So just a quick little lesson. I didn't plan on talking about that, but I want to talk about it. Because we're talking about the market pullback, and to me, I am just looking for opportunities right now in individual stocks that have gotten beaten up, that are still great long-term plays. I was in a car this morning, which I'm never in a car, as you know. I just recently bought one, but I was in a car this morning, and I was listening to, I guess, Sirius XM, whatever they call it now, to Bloomberg Network, the television network. And I prefer Bloomberg over all the other garbage that's out there, but they're even becoming biased, I guess you want to call it. Maybe because Michael Bloomberg's pissed off because he couldn't get a nominee, or couldn't get anybody even back him, really. He spent a shit ton of money. So maybe that's why he's pissed off at everybody. But they're talking about the leading economic indicators, LEI, and some of the University of Michigan consumer numbers came out today. And for the most part, numbers are pretty damn good. But they kept saying, well, the growth is slowing. Well, when you have growth coming from a deep recession, from a deep bear market, and you look year over year, obviously the growth's going to be super high. The percentage can't stay that high. You're still growing, but the percentage isn't that high. So it's these gosh darn, commentators. And trust me, folks, I was on Fox Business and Fox News for over 10 years. I was with Glenn Beck at the Blaze for a while. I've been on CNBC, I've been in Bloomberg, I've been on all the damn networks, CNN all the time. I know these people, and a lot of them are my friends, and a lot of them are great people. But there's a large portion of them that all they do is they look pretty and they can read a teleprompter. They don't know anything about the stock market. And the producers behind the screen that are writing these scripts know even less half the time. So they don't even know what they're talking about. They're just putting the spin to make their bosses on the second floor look good. Nice second floor, because that's where they were at Fox. That's where Rupert and all those great guys sat. That was sarcasm, by the way. All right, so enough of the high horse here. This Dunkin' Donuts coffee gets me jacked up, so I apologize. And I've been up a few hours. But let's get to the IPOs. As I mentioned, this is a huge, huge week for IPOs. Biggest week since Uber back in May 2019. We had the largest software company ever to go public this week. It's been all over the news. You've probably heard of it, called Snowflake, symbol SNOW. They netted $3.4 billion in their offering. It's the most ever, as mentioned, for a software company. It's basically a cloud play. Buffett is an investor, Warren Buffett. He agreed to invest up to $550 million once it goes public. It's a cloud data platform company. The IPO priced at $120 a share, which valued it at that level around $33 billion. It opened Wednesday at $245, so more than double that. Closed at $253. We're down to $224 right now. So been all around the low twos to mid twos for the most part. What's amazing is during its last private raise in February, that's not that long ago, earlier this year, it was valued at $12 billion. Now at the price we're at now, what are we at now, $60 billion or something like that? If I'm doing the math correctly, I think we got to be somewhere around there. Let me see what we got. Yeah, $62 billion. I mean, holy smokes, 12 to 62. If you were an investor just 7 months ago, you made 5 times your money. Holy smokes. But it's all about the cloud. It's all about data. It's all about working from home. The more demand, more demand for cloud, more demand for data. About 3,100 customers, so they have quite a bit of a customer list. 56 of these customers generate at least $1 million in sales for the company. So it is obviously a huge company at $62 billion already. But the thing is, to me, you still have to you have to look at valuations, and to me, it's a little bit ahead of itself. I would never buy it here on its 3rd day of trading. I would definitely hold off. I mean, this could go down to into the 100s pretty easy, maybe reevaluate that time. I think there's a couple other plays out there a little bit better, but we need to talk about it because it's the largest software IPO ever. Another one that I found, I'm going to save that one to last because it's my favorite one. SUMO Logic, SUMO, went public. That is trading right now around 25.30, down about 5% today. SUMO came in, they priced at $22 a share. They opened Thursday at 26.64, so a little bit above the level. They offered just under 15 million shares. They were estimated originally to open between 17 and 21, so they opened above the original price, and then the shares opened even higher. They got about a market cap of about 2.5 billion right now, so much, much smaller. But it's a real-time analytics software company, so very similar to like the data type play. Competitors are SPLUNK. You probably heard of SPLUNK, SPLK, Elastic, which is I think ESTC. I always mess that symbol up. Let me double check for you. Yeah, ESTC is Elastic. 2 companies that have had some nice runs. 2 companies that got some really good numbers. I mean, Splunk went public. All the way back in 2012 now. I didn't realize it was that old. But it was down in the 20s and it rallied up to over $200 just last month. So it's had a nice run in the last couple years, 8 to 9 times. Revenue for the last 6 months that ended July 31st came in at 96.6 million. It was up 38% over last year. But again, if you annualize that out for 6 months, it's what, 200 million, obviously, give or take. And if we have a market cap of 2.6, it's still a bit pricey. But again, these software companies trade at huge premiums, and that's because it's just great business models. So SUMO is the one to keep an eye on. Again, 2 days into trading, so I'm not looking to jump into it right now. Another one with a great symbol is JFROG, symbol frog, F-R-O-G. This is a development ops company. So think of GitHub. GitHub was a company that helps these developers develop websites and stuff. When I had CrowdVest, my equity crowdfunding company that I sold earlier this year, my developer used, I believe, GitHub to do it. DevOps is what they call it, DEVOPS. That's a type of it's a niche sector that it's in. Well, JFrog came out and they priced at $44 a share. They opened at $71.27 on Wednesday and as high as $77 on Wednesday. Today it's basically unchanged. It's sitting around $64.50 a share right now. It's got about a $6 billion market cap. I don't know if that's based on this price right now. Let me see what I come up with here for you. Yeah, about a $5.7 billion market cap. So again, mid-cap company. If you think about it, GitHub is one of the big names. Microsoft bought them recently for $7.5 billion. This is coming in around 5.7. So it sounds about right. Over 5,000 customers. 75% of the Fortune 100 are their customers. That's great. They apparently have a retention rate of 98%, which is huge. Last year, though, it lost $5.4 million. So it's one to keep an eye on. Again, it's those niche. I don't want to say work from home, but it does help work from home. There's more development out there of more online stuff every day. So it is one definitely to keep an eye on. And the last of the, there's more that came public this week, but the ones that really kind of caught my eye. The last one was AMWL, AMWL. And this is basically a competitor to Teladoc. Everybody knows I love Teladoc. We've had Teladoc for a very long time, since early 2018. I believe we're up over 400% on that. We had Livongo in our early stage investor newsletter as well. And we all know Teladoc's buying Livongo. Livongo is another stock that we're up, I think, 250 or so % on in less than a year. So we've had a hell of a run with these telehealth companies. And I was one of the first people ever in this. And I hate to be braggadocious, but I've been pounding the table on this stuff for a long time, way before COVID. COVID accelerated, but way before this. So AMWL is basically short for American Wellness. So as I said, symbols AMWL. They priced their IPO at 18, well above the 14 to 16 range. It opened yesterday at 25.51, so well above that. We're down to 22.55 here this morning, Friday morning, down another 2.3% today. They raised about $742 million. It's backed by Google, so Google's backing it, which is nice. You know, when it comes to telehealth, there's plenty of space out there for a lot of these companies to be in there. You know, Teladoc is the leader of them right now, about a $17 billion valuation. AMWL is coming in. Let me see if I can get this. I think it's about 5 or 6. Yeah, $5 billion valuation. So, you know, about a third, about 30% or so of it. Not quite the size yet of Teladoc. It is one I'm keeping an eye on. You know, again, with IPOs, you get so much information, but you want to see how they trade. We talk about that J curve a lot, where a lot of times you'll run up and then it dips down before it comes back up. I talked about that in Tuesday's podcast. If you missed that, I'd recommend checking out Tuesday's podcast. So again, all ones to watch. I'd watch all 4 of these right now. You know, of the 4, if I had to buy one, I'd buy AMWL, but I'm not going to right here. I like the fact that Google's behind it. You know, the way I look at this is, you know, a lot of these telehealth companies, like Livongo was bought by Teladoc. I'm not going to mention, but we've got 3 or 4 others in the future of healthcare portfolio for early stage investor that have to do with telemedicine, not necessarily just like telehealth, but remote monitoring and stuff like that. So that's the future. And I think a lot of these will be bought by companies like Apple, like Google. You know, we talked about Apple on Tuesday's podcast before the actual event, and the event was after that. The event was all about the watch in healthcare. I mean, if you listened to that event or even just read through the highlights, and I've been saying this for years, Apple is going to be one of the largest healthcare companies in the world. I think that was one of my predictions a year or 2 ago. It will be one of the largest healthcare companies. The new watch has the oxygen levels in it, as we all thought, better ECG. I mean, it's going to be amazing. I mean, I think it's going to be truly Apple's next big iteration of products will be healthcare. And there's going to be a huge multi-trillion-dollar opportunity there. For a company that's about $2 trillion, they need that. But you're going to see them smash up, grab these smaller companies like this, and AMWL could be a great takeover target. Never buy a company based on that, but it could be a great takeover target. And I like the fact that Google's involved in it as well. So a lot of good stuff going on here in healthcare, a lot of good stuff going on in IPOs. So that's where we stand with that. Another big announcement to make on Monday. So what's Monday? The 21st of September. Around 4 p.m. East Coast time, we're launching a brand new product. And people have been asking for this, so we're going to be really happy. You know, we have what we call Matt McCall's Ultimate Crypto. We call it Muck in-house, you know, McCall's Ultimate Crypto. Our Ultimate Crypto portfolio we launched on January 7th of this year. These are small altcoins, alternative coins to Bitcoin. Some are very easy to buy, some a little tougher to buy. But of the 11, 8 of them at least doubled at one point. One was up over 600% at one point. Our portfolio itself as a whole is up over 100%, is more than doubled. Everything's pulled back a little bit, but still up over 100%. And so I've gotten together with one of the first people ever to buy Bitcoin, buying it in single digits. Used to own one of the largest ways to buy Bitcoin before Coinbase, before Gemini, before Binance. I mean, he was heavily featured in Bitcoin Billionaires, if you've not seen it. Charlie Shrem. So Charlie and I have been working for the last 6 to 12 months together. That's why I was in Sarasota last month, down there meeting with him for a few days, coming up with a system and a very new product to build our own altcoin portfolio. And you know, the Ultimate Crypto is still the creme de la creme, if you will. That costs a couple $1,000s a year, and it's worth every damn penny. I think we should charge more. This is going to be for the people that just want to get their feet wet and get in it. You'll have access to Charlie and I. We'll be doing monthly updates, and we will be having a portfolio. We're launching 4 or 5 altcoins right off the bat that are instant buys for you that Charlie and I have worked together and come up with. You know, keep in mind, this guy's got his ear to the ground when it comes to this industry more than anybody else. So super excited. That launches Monday. So get ready for that. You'll get more details about that. But please, if you need anything, I'll put a link down below here in YouTube if you want to have a link to sign up for it. You'll get notification when the event goes live. We actually sat down, Charlie, myself, and our good friend Lauren Savan, who hosts a lot of my events, former Fox News anchor. We all sit down, and we put together a really nice event. So I look forward to everybody joining us and watching us on Monday night for that. If you miss a Monday, we'll have replays. But it's very, very exciting. Again, we're offering this product. It's for less than $100. So we are coming in like very low. So if you, I mean, there's no reason not to jump into this and have access to both myself and Charlie. Super, super excited. But again, launching Monday, September 21st. And we'll let you know more and more about that as we get closer. And of course, next Tuesday's podcast, I'll talk about it as well. So 2 more sections we're going to talk about here. Obviously, we're going to talk about your questions at the end. But before we get there, there's one sector I want to talk about that's been doing really well, and it continues to be overlooked by most people. And that is housing and building materials. My brother-in-law, I think this was his grandfather or his father and his uncle are twins, opened one of the largest real estate firms in eastern Pennsylvania, was eventually bought by Warren Buffett, Berkshire Hathaway. But he's still one of the president there and runs it. Spoke with him yesterday about the stock market. Of course, my family always calls me for stock market ideas, but we were talking about housing. This is in eastern Pennsylvania. And he said houses between $250,000 and $500,000 are going like hotcakes. He says they're getting 10 offers. He's seen several homes that list for $350,000. They're going for $400,000. People are just looking to get kind of these suburban areas, get out of the city. I mean, for where I grew up, you're an hour from New York, you're an hour from Philly, or not even an hour from Philly, 45 minutes from Philly, and you could, get a mansion for $1 million with acres and acres of land. Where in New York City, for $1 million, you get a decent 1-bedroom if you're lucky. If you're lucky, I'll tell you that, because I lived there for many, many years. I mean, parking spots can be several $100,000. So, and cost of living is much higher. So people are moving out and looking at places like this. You then have mortgage rates, a 30-year fixed mortgage rate for the week, this past week, averaged 2.87%. I mean, that's like free money, folks. It ticked up a bit from the previous week of 2.86, so it's near historic lows. But last year, this time, we thought it was low, and it was at 3.73%. This is, of course, a Freddie Mac survey. And also it came out and said, in August, first-time home buyers, believe it or not, the activity rose 19% from July to a highest monthly level ever for Freddie Mac for first-time home buyers. That's a great sign, man. You got to love people getting out there buying homes, putting money into homes, not spending it on BS. The 15-year average is down to 2.35% from the average of 2.37 week before, and from 3.21 a year ago. So if you're able to lock in a 15-year mortgage and borrow money at 2.35%, do it. That being said, this weekend, you all know I'm at my condo right now, overlooking the water, looking at this yacht, which I don't know what this yacht's doing here. If somebody knows, please tell me. I've been looking at this yacht for about 6 weeks now out here. And this yacht is, I looked it up, it's got to be about $60 million yacht, if not more. I think it's got to be in the $100 million range. I mean, there's yachts next to it that look like peanuts. I mean, this thing is freaking huge, and it's been sitting there. It takes up to half the harbor. And I just wonder, no offense to Baltimore, but why the hell would you have it parked here in Baltimore? It seems like it's not getting good use of its money. But I guess if you can afford a yacht that big, money's not a problem. But it gives me inspiration every day to work harder to get that yacht. Though I wouldn't get a yacht, but I'd spend on something. That being said, looking at houses 5 miles, 6 miles outside the city, maybe get some land and get more of a house. So I've been looking, and I'm actually going to look at a couple this weekend, and it's amazing. The good ones seem to go really fast, and with mortgage rates as low, it's almost a no-brainer to do it. Just had the guy where at my fitness facility who owns the building call and said, hey, do you want to buy the building? And I said, I might want to buy the building. Unfortunately, Yoga Works, which is a publicly traded company, symbol YOGA, I assume this is public knowledge by now, is trading at 6 cents a share. It's worth like $1 million market cap. I mean, it's sad. I think they had 60-some locations going out of business, Chapter 11, and they took up the second and third floor. So looking to potentially take that over and open and expand the fitness empire. But again, only reason I'm considering is because you can borrow money so cheap right now. And all very wealthy people I've ever met in my life, billionaires and multi-millionaires, and these are people who have made it themselves, not born to money, take advantage of times like this. So if you have money out there, and cheap money, borrow it, leverage yourself. It's okay. Don't listen to this Dave Ramsey, Susie Omer, and BS, where pay off your credit cards and pay off your loans. If your loan's at 2 or 3%, absolutely do not pay it off. Because if you could use that money somewhere else. If you're double digits, yes, pay it off. But come on, man, that stuff is BS. Don't listen to them when it comes to that. They drive me nuts. And I think they both do have a place in society to help people, but do not listen to that BS. All right, so ITB is the ETF. That's a symbol for the home construction iShares ETF. It's one to keep an eye on. It's trading right near a high. I do have that for Penn Financial Group clients. We've had it for many, many years. I think we're up over 100% on it. Another one's the S&P Home Builders ETF, XHB. Again, very similar holdings, but different, near an all-time high as well. And there's one company which is a recent IPO, so I figure I'll talk about this. And I think I talked about it when it went public back in June, or I guess it was June. It's called the AZEK company, symbol AZEK. So it's similar to Trex. You know, we all know Trex is the composite wood. I love Trex. I think it's fantastic. I looked to put it into my house in Nashville for the rooftop deck to replace it because the sun would beat down on it. And holy smokes, was it expensive. I ended up selling that house and not putting it in and not redoing the deck. I will say I tried to stain the deck and power wash it myself. It ended up being like 3 tones because I was such a schlub at doing it. That's why I hire people to do stuff, because when it comes to that blue collar work, I gotta tell you, I am just not good. I try, but I'm just not good. I do not have the patience for it. But AZEK, A-Z-E-K, is a company that I know I talked about it before, maybe when it first went public, but it's basically a competitor to Trex. The AZEK company, it's about a $5 billion company, and I like it here. It's pulled back. This is a similar situation to when I talk about stocks pulling back. It was in the low 40s, now it's down to 32.60 or so. It's down about 22% from its all-time high. And, excuse me, expected this year to bring in about, excuse me, 69 cents per share. Next year, 90, a year after that at 111. So we're seeing very nice bottom line growth. Revenue going from about $882 million this year to a little over $1.1 billion 2 years from now. So again, not huge growth, but decent. Valuation-wise, if you compare it to Trex, it is a little bit cheaper than Trex. Not the cheapest company in the world, but it is one you want to keep an eye on. So just to throw it out there, if you're looking at home building type stocks, I think you look at that. Home Depots and Lowe's are both down today. Somebody came out and downgraded them, said that the rebound may not be happening like they thought. I don't know. I mean, everybody I talk to goes to Home Depot and Lowe's. I mean, it's packed all the time. So I beg to differ from that analyst call. So we'll wrap that up. Now let's get to, of course, the fun part and talk about the trends. I asked everybody on Twitter this week, and again, it's Matthew McCall at Twitter. And please comment below. So we always get like 30 to 40 comments. I want to get the comments up to 100. Comment other people's stuff. Let's get this community fired up, because I'm trying to get this show up and running. I want to do more shows. We need comments. We need audience participation. I'll jump in and reply to you too. The more you do, the more I'll reply. So let's get into it. So I took some trends. Instead of stocks this week, I took trends. Well, one was biotech, and I took some of the first ones that came out. You know, if I look at biotech, you know, I've talked about this as the decade of biotech. You all know I love this. Biotech hit an all-time high in July and then pulled back when a lot of other sectors were hitting highs. Pulled back about 15%. And I remember saying about 2 weeks ago, it is sitting on price support. It's sitting on the 200-day moving average. And since that time, it has already popped already. I'm talking about the IBB, the NASDAQ Biotech ETF. It's up about 8.5% from there, still down from the low. But I will tell you, I love biotech stocks long term. You know, the ones that have been on my watch list that are pulling back, love them, love them, love them. There's one key to this. And I talked to somebody yesterday that's a potential client for Penn Financial Group, and we talked about biotechs, or actually a new client. And he said, yeah, I just, you know, when it comes to biotechs, you know, if they don't move anywhere in a year, it bothers me and stuff. And that's what most people say. With biotechs, you have to be patient. You just have to kind of let them go. You build your basket. You know how we build our baskets. Build your basket and let it go. Next one was financials people asked about. And I'll just look at the XLF, which is the Spider's Financial ETF. The financials have struggled and have not come back nearly as much as a lot of the other sectors. The XLF, which is made up of a lot of the big names, JP Morgan, Morgan Stanley, Goldman Sachs, you name it, still down 20% from the all-time high. Up off the lows, don't get me wrong, but still well down from the high. Never came close to breaking out to a new high. A lot of that has to do with interest rates, in my opinion. You know, interest rates that are low do not help banks, because the higher the interest rates go, the higher the margin, because the banks borrow at one price or one interest rate and lend out at another. The higher the rates go, the bigger the margin that they can actually borrow than charge. The lower interest rate's not as good. And we have the 10-year sitting at 0.69%. It's been basically flat for the most part for the last few months after the sell-off or after the pullback in March. It's tough for banks to really get the margins going. IPO should help the investment banking side of it, but financials, to me, I think there is a lot of possibility looking forward. I'm just going to pull up JP Morgan just because it's just the first one that popped in my head. You know, it's a $300 billion company. Just looking at the estimates, this year you're looking for, you know, earnings per share last year were $10.72. So it's dropping this year to $5.73, nearly in half. But by 2022, back to $10.40. And at $10.40, if you're trading, say, 15 times earnings, that's a $150 stock. Right now, JP Morgan's at $98.49. So it's about 50% to the upside. And that would take it to a new all-time high. So that's longer term. Yeah, I think they're nice plays down here. And just for full disclosure, we do have JP Morgan for clients at Penn Financial, just to let you know. And again, nothing I talk about here is a recommendation. Do your own due diligence. I may own, my clients may own, or our subscribers may have in our portfolios any of the stocks I mentioned. But again, none of these are recommendations. This is all just me sharing my thoughts. Third trend that we asked about was 5G. I still love 5G, man. I mean, we're in the early stages. Commit to it, hold it. I don't care about COVID. I don't care about the next black swan that's out there. There's going to be 5G is going to continue to expand between now and the end of the roaring 2020s, no matter what. You want to be in these stocks. Very simple. In-home fitness, somebody else asked about. Peloton, you know, the more I look into Peloton, the more I love it. It's pulled back from a high. It got close to $100. It's at $85.10 right now. I want to buy it. I just want to buy it around like 73 to 77. Let's call it 75, somewhere in there. If we can get down there, I'd probably be a buyer. Yesterday's low was what, 80, or yesterday's low was, I can't even get this. I think in a 79.02. Probably should have jumped in. It's 85 now. I don't know, but I like the in-home fitness. As I mentioned, Apple is all about healthcare, fitness. I mean, that's huge. Another one to keep an eye on that people often overlook. This is like a blast from the past. Remember Nautilus? NLS is a symbol. Nautilus. If I take a look, you know, back in October, this stock was $1.20. It's at $16 today. $1.20 is $16. That's what, a 12, 13 bagger, 14 bagger. This stock was way back in the day much higher. If you go back to 02, the stock was up around $46 a share. Came all the way down, as mentioned, to $1. But they have some nice products out there now, so it's maybe one you want to keep an eye on. But there's a couple products out there that look pretty good. Another thing people asked about was inflation. Inflation came out today. It was a little lower than expected in the numbers that came out. Expectations for inflation, I say, not the actual inflation number, in the LEI, leading economic indicators. To me, inflation, the Fed said they're going to let it go. So we're going to see inflation, but it's okay. But what it's going to help is going to help precious metals historically, but gold has been flat for the most part for the last 2 months. The gold stocks have been flat for the last 2 months, and that's okay. That could be consolidation. Silver stocks, very similar. I love the silver. I like silver over gold personally, but you all know what I like, right? I think the best hedge against inflation is Bitcoin and altcoins. So to me, cryptocurrencies are the best hedge against that. And also you can look at land. Land is usually a very good hedge against inflation. But the bottom line is when you have inflation, typically stocks do very well, equity. So you want to be in a stock market. So everything that we've been talking about, stock market, altcoins, you name it. Somebody talks about climate change and ESG, basically, you know, socially responsible investing. I think they used to call it socially SRI. Yeah, SRI they used to call it. Now it's ESG, environmentally, socially, and governance. I don't even know what it even means anymore. But I know it as the old school SRI, socially responsible investing. It's big. I mean, I think a lot of it's BS because a lot of companies out there fall into this category, even though I don't believe that they really they should fall into the category. So it is what it is, but what I think about it's irrelevant. All I know is that it is a trend. I know there's more money flowing into it. More companies are being cognizant of it as they should. And I think there's a big opportunity there to invest in companies like that. One area that we're launching a new portfolio within the next month, I'm still doing all the research on it, is solar. I think solar is going to be huge. And I'm not saying I'm ever going to put solar panels on a house if I have a house. Again, I'm in a condo. I don't want it all over my walls. But it's going to come to a point where it's, you know, the future of solar. You all know I love batteries. Our solid-state battery portfolio is up over 100% since we started it less than 2 years ago. There's a great opportunity out there in some of these sectors. I'm not saying in general. You know, to be honest with you, I like wind power. The wind ETF, which is FAN, FAN, which I love these symbols for these ETFs, is up 20% year to date. TAN, of course, which is solar, I believe is doing a little bit better. Year to date is up, doing much better, 80%. But I still think there's a lot of great opportunity in wind and solar and batteries. So yeah, I'm good with that. EVs, electric vehicles, there's great ways to play this, but you have to be careful. It's not just a blanket ESG or SRI, whatever you want to call it. The last one people asked about was data, big data. I mean, the amount of data that's being created is insane. The amount of data that's being created in healthcare by genome sequencing. I'm going to go to this place in San Diego before the end of the year. It's several $1,000s. I think the high-end one's even $12,000. That's with a discount, to have all my genome sequenced, to have all this full-body MRI, all this cool shit done. And I'm going to hopefully video it, do a whole write-up about it, write many, many pages, huge report on how it is. Because I feel if I'm going to be at the forefront of this and find the companies that are going to make you all tons of money, I need to go through this myself. So I'm a bit scared to see what comes back, because it's going to tell you a lot of information, probably some stuff you don't want to know, what you're susceptible to in the future, but also could save your life. Who the hell knows? But the amount of data being created from that is mind-blowing. So I love the data stocks. A lot of them got beat up in the last couple of weeks for earnings reasons, but long-term, great time right now to be buying into data. I think data is one of the greatest opportunities out there that people are just not looking at. I think they're continuing for some reason to ignore it, and I think there's great opportunity there for that. So, all right, we're going to wrap it up. But again, please comment, like, subscribe, head over to McCallMoneyWire.com, free articles, sign up for our newsletters. And again, coming out Monday, September 21st, Charlie Shrem, a Bitcoin legend, and myself are launching a brand new altcoin portfolio Monday afternoon. Watch the video, check it out. If you want, I'll put the link down below here on YouTube if you want to check it out to the video. And you can sign up there and get any notifications that you need. But again, it is Friday, September 18th. Right now it is about 11:30 East Coast time. We have the NASDAQ down about 19.5 points. So near the low today. It's okay, folks. I don't care if it closes down 30 points or close up 30 points. This market still looks great long term. We were due for a short-term pullback. We're getting it. It's creating opportunity. Stay positive. This is when people make money, buying into very strong companies and strong stocks on pullbacks like this for the long term. Have a wonderful weekend. Be safe. Be happy. Give someone a hug. Wear your mask if you're supposed to, all that kind of stuff. But number one, get some damn fresh air. Breathe it in. Enjoy it. Enjoy life. And we'll be back Tuesday. Again, I'm Matt McCall.
Thanks for listening to Moneyline with Matt McCall. To find more information, head over to McCallMoneyWire.com. That's McCallMoneyWire.com.